Hello, everyone. Welcome to the 10th Flying with Phoenix speaker series hosted by LTF Ventures, which is UChicago student-run VC. My name is Wesley Fong, and I am the president of LTF Ventures. So before we get started, I just want to take a moment to express my gratitude to David, President Emeritus, for kicking off the speaker series and giving the undergraduate community of UChicago many, many amazing speakers across industries. And so check out those recordings on ltfventures.org. So thank you again, David. And then without further ado, it is my honor to introduce our speaker today, John Rogers. So John is the chairman and co-CEO of Ariel Investment, the global value-based asset management firm he founded in 1983 when he was just 24 years old. His professional accomplishments extend to the boardroom, where he is a member of the board of directors of McDonald's, Nike, the New York Times. John is also the vice chairman of the Chicago Board of Trustees. John has one of the longest track records in the business. He has been highlighted alongside legendary investors Warren Buffett and Ben Graham as one of the world's greatest investors. Ariel Investment is the first African-American-owned asset management firm in American history, and John also holds a bachelor's degree in economics from Princeton University. So welcome, John, and thank you so much for joining us today.
Thanks so much for joining us, and thank you for allowing me to have our vice chairman, Charlie Bobrinskoy, with us. Charlie, I met at the lab school and as a Booth grad, Duke undergrad, and was an investment banker and ran the Chicago office of Salomon Brothers, and then the branch offices outside of New York City for Salomon. And he's been with us now 18 years as vice chairman. So it's just great to have Charlie on the call too.
Great. Thank you so much for joining us. So, John, I think the first thing I guess I'm itching to hear about was a bit of a lighthearted question, but that time you famously defeated Michael Jordan in a one-on-one game in 2003. So I also understand that you were the captain of the Princeton men's basketball team and led the team to winning the Ivy League title. Have you ever had a thought of becoming a pro basketball player?
Yeah, I could only dream that I could. It is interesting that right when I got to Princeton, there was a long history of a successful Princeton player going on and playing in the NBA. With the most famous being Bill Bradley, but there were, again, several players that sort of right a couple of years before I got there, the year before I got there, there was a guy, Armand Hill, who was a first round draft pick of the Atlanta Hawks, first guard taken the draft. But it was clear I did not have those skills at all. And my coach, Pete Carrill, who's in the Hall of Fame, who's actually a genius, he said that when it came to playing basketball, I was legally blind. I couldn't see anything, and he couldn't teach me vision. So he also had many other colorful things to say about my lack of basketball skills. So I never had that choice, and I didn't lead the team to the Ivy League championship. I was lucky to be on the team when we were champions senior year.
Right. And I guess still on the same topic, after college, graduates from Ivy League universities who want to pursue finance typically flock to the financial capital of the world, New York. But when you graduated from Princeton in 1980, why did you choose to come back to Chicago and work for William Blair instead of going to New York?
Well, a couple of things. I think the number one thing, Ned Janata, who is actually the former chairman of the University of Chicago, Ned's a Princeton guy, and he was the chairman of William Blair when I was interviewing at William Blair. And so he showed a lot of interest in me of joining Blair. I was the first African-American professional to work at William Blair. And it was a terrific opportunity to work for, a great firm. And then again, having the chairman of the firm and the managing partner of the firm interested in my career development was something that was quite enticing to me. And he lived up to that. The 2.5 years I was there, he was constantly, Ned was taking me to breakfast or lunch and helping show me the ropes of things I needed to know to be successful in the finance world. So that was the number one thing. But the other thing was, actually, I did interview with Merrill Lynch back then for a job in New York, and they rejected me. So I was decided it was more fun to come back to my hometown. And then finally, my parents were still living here in town, so that was nice.
Great. And then I guess after William and Blair, you were only there for 2 years before founding Ariel Investments, in which you were only 24. So you also mentioned that you had these connections, these people that were mentoring you, that you worked closely under. Do you think that made it easier when you were raising your first fund? And what were the obstacles of doing so?
Well, it certainly made it easier. Ned was great about introducing me to the people in the investment management and mutual fund sector of William Blair and asking them to spend quality time with me, telling me some of the do's and don'ts of being in the asset management and money management mutual fund industry at the time. He also had another friend who had a firm that was a small firm in Chicago, and he set up a meeting there too for me to get instructions and ideas and thoughts of what mistakes not to make as you're starting money management. The challenges that we had were, as you can imagine, when you're 24 and you're trying to start a company to manage other people's money and to have, mutual funds for other people's money, people want to see you have a track record. They don't want to give you their hard-earned dollars or a foundation's dollars or an endowment's dollars or a pension fund's dollars without seeing a track record. So the number one obstacle was developing a track record in those early years that would entice people to give us a chance. And so we did two things. We raised roughly $200,000 to have enough money to pay myself and a lab school friend our salaries and have a small office, 307 North Michigan. And we thought if we could have a couple $100,000 that lasts us a couple of years as we developed our track record. We raised that original $200,000 from friends and family. Charlie was one of the friends I went to, and he was an investor when Ariel got started. Of course, my mom and my dad and former clients of mine at William Blair and other high school friends and people that I grew up with in Hyde Park, Kenwood. So I always tell people that as you're developing relationships in high school and college, how you show up and, has a lot to do with whether people have confidence in you later when you need their support, if you're trying to do something, original, where you need financial support from others. So that was really the major challenge, raising that initial pot of money so we could stay in business for the first couple of years, and then developing the track record. We developed the track record by two things. One, we started a newsletter called The Patient Investor, where we would talk about our favorite stocks and our views on the market. And we kept track of all those stocks, how they performed on the back page. So people could see and understand our investment strategy and philosophy and see how we thought about individual securities and industries investing. So I think a newsletter was a really good idea, and having it branded as The Patient Investor made people understand that we were going to be prudent and careful with their money, and that we gave us a logo of the turtle, which was memorable when you were trying to get noticed in those early years. Having a tortoise as a logo was, I think, a good decision. And then finally, we went out and raised $500,000 again from friends and family and put it in what we called Ariel Fund. It was the predecessor to our publicly traded Ariel Mutual Fund now. And it was we could develop a real live track record with real dollars to go along with the track record we're developing in the newsletter.
I think another aspect that I think I really wanted to touch on that I think is also incredibly important was when you founded Ariel. That was the first African-American owned asset management firm in the nation's history. So what was it like, I guess, besides just being a young first-time fund manager, but also a Black fund manager at the beginning of your career?
It was a plus and a minus. I think the pluses, and Charlie and I have debated and discussed this for years and years, because it's gone on 40 years. The benefit clearly was it got us noticed. Being the first, People magazine did a story in 1983 on us that was great. They took me to Brookfield Zoo, and I had a picture next to a giant tortoise. We were reading the Wall Street Journal together. So getting national publicity was because we were pioneers. I was able to get on radio shows and the local stock market observer television show. I would get quoted in the newspapers. And I think, I would call these writers or TV producers or radio producers, being able to say we're the first African-American fund manager, they were interested in, writing about us, letting us come on and talk about what we were doing. And we were different. And there was a sense of progressiveness there. On the downside was, most progressive companies and institutions, universities to corporations, when they think about working with minority firms, they think about working with what they call they develop supplier diversity programs. And that's the well-known term in our, throughout the nation when it comes to working with minority companies. And that implies that when you work with a minority company, it's something in the supply chain. construction, janitorial services. Those are important jobs, important career paths, but they leave out money management, investment banking, technology, all the parts of the economy where the wealth and growth and jobs are being created are left out of these well-meaning programs. So to answer the challenge for us is whenever we went to see a CFO or a CEO or someone to think about getting hired, they just couldn't compute it. It was like, we've never seen anyone black come and talk to us about this, And so I often joke that we would have 90% market share of all the universities in Chicago if we were in construction or catering. And we basically had, zero opportunities in those institutions. And the University of Chicago being the rare example that has a true commitment to working with minority businesses in everything that the economy has to offer, not just these low margin traditional ways of thinking.
And to that point, do you think there has been major progresses, I guess, in the industry's diversity and inclusion? Are there still steps to go?
There's still a lot of steps to go. I mean, there is progress for sure. After, it's taken a long, long time. And in some ways it took the tragic murder of George Floyd to get more and more corporate executives to think more expansively of how to work with minority businesses. I've seen a lot of it in the endowment market. Many more universities with large endowments are for the first time thinking about working with minority-owned businesses and asking their majority companies they work with about the diversity of their teams. That wasn't happening 5 years ago. It wasn't happening 4 years ago, but it's happening more and more consistently. And once people start to think about it, they have to be, it's just logical. If we believe in solving the wealth gap in this country, we've got to work with minority businesses in everything they do. And that people realize kind of a modern day Jim Crow, if the black and brown people only do the least lowest margin parts of the economy, and the parts of the economy where a lot of the students at the University of Chicago are thinking about, being in private equity and being in venture capital, being in hedge funds, being in consulting, heads of law firms, again, in technology, which is a huge area, that's just so important. And it's starting to happen. It's finally starting to happen here in the last couple of years.
That's awesome. Thank you so much. I guess now I'd like to move towards just value investing. And I think for the benefit of our audience, could you give us your definition of value investing? And I guess how does a value investing firm differ from other institutional money managers in the public market? Which, for an example, that would be like Citadel or AQR Capital, I guess, just to name two firms that are also run by UChicago trustees.
Yes, well, they're both two really outstanding firms, and we actually own a lot of stock in AMG that owns, controls the AQR. And John Liu is on the board with me at the University of Chicago. He's a great guy, one of the founders of AQR, and of course what Citadel has been able to do, and it's just been amazing with their leadership and their support of the university also. So, but the difference is those guys they're hedge funds. So they get paid in, typically, not exactly, but, hedge funds traditionally got 2% management fees and 20% of the profits. It's why it's one of the most lucrative parts of the ecosystem. It's an extraordinary thing. And, that's why you see so many of the wealthiest people in the country are people from the hedge fund industry. That's an entirely different model than a traditional mutual fund money management company. Fidelity and Vanguard and T. Rowe Price and Janus and the big fund complexes that you see advertised on television and you see them written about and talked about, they get paid traditionally less than 1% of the assets to manage those assets. And mutual funds you see in 401k plans, they also manage institutional portfolios for college endowments or corporate pension funds, and et cetera. But that's an entirely different ecosystem, what AQR does and what Citadel does from what we do. It's actually interesting. Often places like AQR will have people who are picking stocks like Charlie and I do. But again, it's a different fee structure and a different economic model.
And then, so you mentioned picking stocks. I was wondering if you could walk us through the process in which Ariel makes an investment. Do you think it's more of like a top-down approach, or is there a bottom-up approach? Like, do you guys invest in a stock first, or do you study the fundamentals first?
Yeah. Well, one part of that, first I want to answer the other part of your other question I didn't get to, because I explained, you had mentioned AQR and Citadel.
Great.
And so I talked about that, but I also didn't answer the threshold question about defining value. And then I'll let Charlie answer this new question, since he leads our research group and has been with us these 18 years, helping us define how we actually do our stock picking. But for us, a value investor is someone who uses the Buffett strategy of buying a wonderful business in an industry that you understand, that's within your circle of competence. You buy, again, try to find a great company. You want to find a great company that has a moat around it that makes it very difficult for new competitors to come in. That there's something there that's going to allow it for you to feel fairly confident that 15, 20 years from now, that business will still be there. The way PepsiCo and Coca-Cola are still there, or General Motors or IBM, what have you. Companies that you go in for the long run. The other part of value investing is when you want to buy those companies while they're cheap. And typically, a lot of value investors like us want to find a company that's selling at a 40% or more discount to what we think its true value is, its private market value. So value investors want to find companies that, again, are very cheap, that are selling at bargain prices. Value investors also want to find companies that have strong balance sheets. And so if there is a storm and the economy falters, a value company is often going to have a margin of safety there to protect the enterprise over the long run. So that's an important part of value. And, for us, we've been doing this value investing for 39 years. That's what is in our DNA. Growth investors, on the flip side, are companies where often the industries don't have deep moats. New tech comes in and chases out the old tech, and the world is shifting and adjusting very rapidly, and there's often rapid obsolescence. You watch and see what Apple has been able to do, and destroying the traditional, actually the way we used to use phones. Everything is transformed because of Apple's iPhone and what's transformed there. So growth stocks are often going to be in industries where there's lots of rapid change, but if you hit it right, those companies can grow much more rapidly than value stocks. Often value stocks, sell. You're lucky if you can get one that's growing 10%. As we know, growth stocks can be growing 30, 40, 50% a year, sometimes higher, because sometimes lower. But because they're growing so fast, and people often can make a lot of money quickly at a fast growing company, more people sort of jump on the bandwagon of growth stocks and find it can be sort of sexy and exciting, because when you get them right, you can make a lot of money. And what people don't realize, of course, if people don't meet those expectations from growth, those stocks have a lot of downside, which you see today with Netflix being down 35% after being down 40% already year to date. And all of a sudden, when it became clear it wasn't going to grow at the rate that everyone anticipated, it got re-rated and the stock has just completely collapsed. So, growth stocks, again, are companies that are in industries that are lots of shifting, lots of changing, but are companies that can grow very, very rapidly, but they're going to be selling at a high price to reflect the expectations of that future growth. And instead of buying them at a discount, you often are paying a premium and anticipating the company to grow fast into the future. And you won't be able to get a low price earnings multiple or low EBITDA multiple on a growth stock that's well established. So it both ways work, but at the end of the day, a great growth investor has the ability to see the future, a lot of vision way out into the future, to see how Uber's going to become an Uber, or again, Apple's going to become an Apple, where a value investor is looking much more close in, trying to see how that business is going to do over the next few years and making sure it has a moat to last for the long run. So Charlie, anything you want to add to that, and then also talk about the process question, how we actually pick stocks, I guess was a part of the question we got.
Yeah, why don't I take the second part of that? So the good news is that the process that we use to pick stocks is actually very similar to the process that investment bankers use when they're making a presentation to a board about what their company might be worth. And it's the same three methodologies that we use. The first is a discounted cash flow analysis that you learn at the U of C and that all good investors learn pretty early in their career. And you look at projections, you spend a lot of time talking about what the cash flows are going to be. You spend a lot of time talking about what the right discount rate should be, terminal values and all the rest. And that discounted cash flow analysis is a bedrock of the first principle of calculating intrinsic value. The second is a change of control valuation. Again, that's what an investment bank does as well. That's what would a buyer pay for the whole business? What would a knowledgeable competitor, maybe a strategic buyer, pay for the whole company? What would a private equity firm pay for the whole company? That becomes a private market value or a change of control value. And then the third methodology is a full and fair trading value. We're looking at other stocks in this sector. Where can these stocks trade? There's sometimes some bad news currently in the market, and there's an anticipation that that bad news will go away. What's a full and fair trading value for this company based on comparable companies? And you get, sometimes those three numbers are laid out on what's called a football field, where you get a range for each of them, and you can see, you put different weights on the three inputs to come up with what we call a private market value based on those three inputs. So you get a calculation for that number, and then the goal is to find stocks that are trading at a 40% discount to that intrinsic value. And that becomes your margin of safety. Here's the intrinsic value of the company. Let's say it's 100. We are going to try and find stocks that are trading at 60, which is a discount to intrinsic value. And this goes all the way back to Ben Graham, who was the founder of value investing, who said that if you could buy a stock at a 40% discount to its liquidation value, then you had a margin of safety. And then of course, you're complying with Warren Buffett's rule. The first rule of value investing is don't lose money. The second rule is never forget rule number one. So that's in a summary what our investment process is. There's a little more to it, but that's basically what we do every day in looking at the stocks that we're thinking about buying.
We have and that's the only thing we add. We have a whole team of people. I think 5 of our senior people are U Chicago Business School grads from Booth. We have a couple of other younger analysts also from Booth. So it's been really important to us. And each of those analysts covers a specific industry where they're experts in. And they're waiting until companies within their industry groups get cheap enough for them to be potential buys. So we really want each analyst to have deep expertise in no more than 2 industries and know them really, 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 really well. We get to spend a lot of time with management teams, visiting the company headquarters, getting to know the CEO and the CFO and all the top people, and building deep knowledge, again, around each and every company. Talk to competitors, talk to customers, talk to board members, anyone that can bring some insight. We always say we're trying to not just depend on our analysts for the work, but make sure that we're touching as many experts as possible to help us with the final decision on whether to buy a stock or not for our portfolios.
Right. I have a follow-up question for that. So value investors, I guess, as they look for bargains in shares of undervalued securities, some of it might be in under exciting industries, but Cathie Wood, however, has in recent years attracted lots of attention to investing in highly volatile tech stocks in very disruptive industries, such as, I guess, gene editing and space exploration. But yet some people call her a deep value investor. Do you think the definition of value investing is shifting in a world where many traditional industries are being disrupted?
No. And Charlie could chime in too. I think what happens though, when you have such a long period where growth stocks outperform value stocks, throughout the history of the markets that are, going back to 1926, value has outperformed growth over the long run. And Charlie and I talk about that all the time. There's a lot of research, again, done at the University of Chicago that shows that value has been a winning strategy. But when you go through a 10-year drought where the growth guys are killing the value guys, a couple of things happen. One, everyone rushes to the growth stocks. They get way more and more and more expensive. The value stocks get cheaper and cheaper. They're even bigger bargains. So that's what happens. People who used to be value investors give up. They get fired by their clients, or they decide that this doesn't work anymore, so I'm going to join the winning strategy. But again, once everyone jumps on that teeter-totter that way, all of a sudden the growth stocks can get way over expensive. They'll be more expensive for longer than you can anticipate. But then what we believe and what history has shown is once people think this is a sure thing, a sure way to get rich, it's exactly the worst time to follow the crowd. And Warren Buffett always says you want to be greedy when others are fearful, and you want to be fearful when others are greedy. And growth stocks have been a time where everyone just has followed on that bandwagon. Again, you look at Netflix today, when it had this expected growth rate as it disrupted this whole streaming world, it justified an extraordinarily high multiple. I don't know what the PE multiple was, Charlie, at the peak. But the stock is down how much this year to date?
Hold on, sorry, I should know that. I think we're down like 70% now. And it was at one point, so as of today, it's down to a 20 PE. It was over 60 PE. And so, yeah, the stock was at a high with 700 in the last 52 weeks, and it's now down to 226. So yeah, the PE was over 60, and now it's around 20.
And that's what it just inevitably it happens. Whenever it's a sure thing, it gets overpriced. That's what we believe. Now, growth guys, Kathy Wood would not sit here and agree with us. So we know the University of Chicago is a place where we have, rigorous inquiry and debate and lots of different perspectives being heard. But history has shown that when people stop tying the value of a company to any kind of firm foundation, it just can't just hold up forever. And then again, what's happened is classic. This is like a classic example of Netflix. You have new competitors coming in with streaming. Disney came in, Paramount Plus came in, Warner Brothers has a streaming service, CNN Plus has a streaming service. You go everywhere there's a streaming service. Lots of them have better content than Netflix. Some of them have sports and news. So all of a sudden people wake up and say, why am I going to continue to pay for Netflix when I can get more from these other streaming services? Plus there's Amazon Prime and there's Apple, and people wake up and say, well, the emperor has no clothes. It shouldn't be selling at 700. It's probably going to go to 100, but I guarantee you at 700, hardly anyone had a sell recommendation on it. Today, everybody went to a sell recommendation, capitulating after the fact.
Right. On a similar note, I think you mentioned that one of the books that had a very strong influence on you was A Random Walk Down Wall Street, which in itself endorses the efficient market hypothesis and I guess argues against practice of timing the market. Do you think your understanding of the efficient market hypothesis has influenced your work at Ariel?
Oh, for sure. Yeah. The markets are extraordinarily efficient. And the one thing that Professor Malkiel talks about it in A Random Walk Down Wall Street, and I've gotten to know him pretty well over the years, is that he talks about the great bubbles that have occurred. If you read that book carefully, he has this great history of when tulip bulbs were exploding, where there was a South Sea bubble having to do with shipping. There was, of course, the 1920s and the stock market booming. There was the 70s. There was another boom. We had the internet bubble. He does a great job of showing you how emotions take over. And some of the things that Dick Thaler talks about when he won the Nobel Prize in behavioral finance is how people sort of stop acting rationally. And those times will happen rarely. So the bottom line is the market is extremely efficient. It's almost always, really, but every once in a while, the market loses its mind. And you can take advantage of those emotional moments and sometimes find bargains, again, when everyone's panicking, or sell things that are very expensive. So there's no doubt about it. Markets are exceedingly efficient, and we have to, it's really hard to convince us that a stock is being mispriced. That is really something that's so important. We have to convince ourselves we understand something that we don't think is really readily understood by the rest of the marketplace.
Just I'll pile on a little bit. even Bert Malkiel would acknowledge that there are some anomalies in the market in which some things actually have been shown to be inefficient. And John built Ariel around the idea that small cap stocks can outperform compared to what the efficient market says they will, and value stocks can outperform. And so John really has built his career on being a small cap and mid cap value investor. So even the biggest proponents of efficient market theory do acknowledge that there are some anomalies. We've tried to build our firm around taking advantage of those anomalies, as have the people actually at AQR. So even the Gene Fama and the table pounding proponents of efficient market theory would say there are pockets of inefficiency.
But yeah. But one thing I'd say too, because you guys are, experts in venture capital and work that you guys are doing, there are opportunities when companies are, again, by definition, when you're investing in a venture capital situation, the companies are going to be quite small. Right. They're not going to be well researched. They're not going to be well followed by Wall Street. And you do have an opportunity to find some real inefficiencies in the world of startup companies and companies getting going and building momentum. And if you happen to be around someone who has, extraordinary vision and cracking the code and disrupting an industry, enormous amount of wealth can be created there. So that's where I would focus on. If I was a growth investor, I'd be working with those smaller growth companies where I would think the upside is extremely terrific if you, really work at it and make that your life's work.
Great, thank you. I'd like to turn more to the world economy now and ask about what do you think will be the effects of higher interest rates on value investing? I guess just to preface this, we had David Rubenstein on our show, and he mentioned that interest rates weren't actually that high if you zoom out and look historically. I guess he gave the example of the 1970s. But yeah, any thoughts on that?
Well, Charlie has been a regular on CNBC talking about this exact issue. He comes on several times a week, it seems like a lot. And he's also chairman of the investment committee at State Farm, where he serves on the board. So he's our in-house expert on interest rates and inflation.
Yeah, this is one area where John and I have some advantage over younger people, because we do remember a time when mortgage rates were 13, 14%, when the treasury rates were over 10%, and that was 1980. And interest rates have come down steadily since then. And so younger people have believed that 3% treasury rate is a high rate, because they, of course, saw 0.7% and even negative rates in some European and Japanese bond markets. So the short answer is, if you go all the way back in history, the average 10-year treasury is about 4%. And the lowest 10-year treasury we had ever had was 1.4% the week after Pearl Harbor, when people searched for safety and bought treasury bonds. And other than that, there had never been a time when interest rates were as low as they got in the last 3 or 4 years. So the last 3 or 4 years were a very unusual time. Frankly, our theory is that the Federal Reserve, through quantitative easing, was buying about $120 billion a month, and they accumulated $9 trillion of bonds. And that drove the price of bonds up and interest rates down. And that was an artificial level that frankly didn't make a lot of sense. Now, it wasn't terrible when inflation was low, but there was still not a real return on bonds. And so now that inflation has come in much higher than the Fed thought it would come, we're getting a return to normal rates. But the 2.9% 10-year treasury that we have now is still under average for the history of the country, and is still, in our opinion, way too low for the inflation environment that we have. So it's always hard to make predictions about markets, and John and I are very humble about knowing that neither we nor anybody else can make a lot of short-term predictions about markets, but interest rates should naturally be higher than they are now. And the good news is that higher interest rates are better for value investing than for growth, because growth companies, by definition, earn their profits in the distant future. And so a higher discount rate brings those present values back to a lower number than a low discount rate does. Value stocks, by definition, are earning more of their earnings in the near future. And so higher discount rates have less effect on the value of value stocks than they do on the value of growth stocks. And so one of the reasons why this year value is doing very well compared to growth is because interest rates have been going up.
And then when you guys, thank you, Mr. Berinsky, when you guys look into a company, is there more of an emphasis now on like what kind of companies can actually do well in an inflationary environment?
Well, there's clearly different types of ways to play that. You know, Charlie for a long time has been a believer in commodities. So gold and silver, fertilizer, oil, energy, yeah, all of the above. There are other ways to play, of course, real estate. Our favorite stock right now is Madison Square Garden Entertainment, that owns Madison Square Garden itself in the middle of downtown Manhattan. So if you think Manhattan real estate is going to go up in an inflationary environment, you want to own like that iconic asset in, you know, arguably one of the world's greatest cities. So real estate is another way to benefit from higher inflation. And you want also, we think, value stocks, some of the consumer branded goods companies that have pricing power, that have proven over time that they can add to their price points and not lose market share. You want to have those kind of strong brands in your portfolio in an inflationary environment where people are going to still keep buying their Coke or their Pepsi or what have you, even if the prices go up a little bit. So there are ways to make money in an inflationary environment, and something we're spending a lot of time on, hopefully getting ourselves positioned. We have several funds at Ariel. Charlie's fund has been having a great year because he's been emphasizing a higher percentage exposure to commodities than the rest of our portfolios.
And John, I think before the pandemic, you mentioned in an interview that if you were to distill the success of Ariel to one point as to why you're able to consistently beat out your peers, you said that you took more of a long-term outlook, irrespective of short-term fear and volatility. Do you think that's more true now, given the context of the pandemic?
Well, it was just another example of that. I think the ability to look out over the horizon, have a long-term view is more and more rare in our society, but those that are willing to do that and have the ability to do that, I think are successful or more likely to be successful. I think that's actually for growth or value investors. I think either way, you've got to be optimistic about the future. And I constantly, if you go to the Berkshire Hathaway annual meetings, I would encourage all of you guys to either go to Omaha for the annual meeting or watch it on live stream. Warren Buffett always says every year that last century, the Dow Jones Industrial Average started the century at 66. It ended at over 11,000. And if you think about it, last century, you had 2 world wars, a Great Depression. We know they had a pandemic 100 years ago. Presidents resigned, presidents assassinated, all kinds of extraordinarily difficult things. Many, many recessions we went through, but the market steadily marches on. And Warren says our capitalist democracy is the best system ever invented. So that's the reason I believe that if you have the ability to look past the emotions of the moment, the storms of the moment, the headlines of the moment, and look out when the sun's going to be shining in 3 years, 2 years, or sometime in the future, you'll be a much more successful investor than if you trade based upon the short-term noise, the short-term news.
Right.
The other thing is part of that, which I think, again, you guys as University of Chicago students know, the University of Chicago is known for having, a lot of idiosyncratic folks and people who think independently, who are proud of their ability to be a little bit different, think a little bit differently, don't feel the need to follow the crowd, be like everyone else. Something I love about the university. And I think that is equally important in this business, is the ability to make your own independent judgments of what you think is right and not be swayed by whatever the group think of the moment is. Because very, very often, once everyone comes to a conclusion of one thing, it's exactly the wrong thing to do.
I'm glad you mentioned Warren Buffett. I think last month he released his shareholder letter where he emphasized investing in America. Are there sectors of the US economy that you are particularly bullish about? And I guess, will they thrive in the face of growing international competition, particularly from China?
Well, our biggest holdings are companies that we think will be able to do well and have more and more of a domestic focus. So as I mentioned, Madison Square Garden Entertainment directly. We also own Madison Square Garden Sports that actually owns the Knicks and the Rangers, which we think is the kind of company that will do really, really well here in America and won't be impacted by what's happening around the world and the China challenges that we see that are out there. We do actually have an international global product at Ariel run by a dynamic woman named Rupal Bansali in New York City, and she focuses on our international and global investing. And but Charlie, what am I missing there about that question?
Well, we do think, frankly, that what's happened in the last year or two has made people focus on the supply chain and the power of having suppliers here at home. And so you mentioned Chinese competition, and that's clearly been a trend for the last 40 years for globalization and outsourcing. But there's an insourcing trend right now that is favoring US manufacturing. And so we own some industrial companies, some tool and die companies. We own one company called Kennametal that makes simple tool and die products that are going to benefit when people are building new roads and cutting into rock formations. So the U.S. industry is strong, and we have a rule of law here in the U.S. that people often take for granted, but the sanctity of contracts, the stability of regulation is a real power of our country, and it's one of the things that Buffett points to when he talks about why the U.S. has been such a wonderful place to invest.
And maybe I add one last quick thing too. As I mentioned earlier, you mentioned in the introduction, we've been lucky to be on some really good boards, and being on the board of Nike, where Phil Knight is still active and at every board meeting, and Tim Cook, is the lead director, the CEO of Apple. They're talking a lot often about how important it is to have more exposure to more different parts of the supply chain, not being so dependent on one nation like China. It's so important to be able to spread things around, spread things out. Same things happen. We own a lot of stock in Mattel, toy company. They've really worked hard to not be dependent on just one nation. And I think people are getting smarter and smarter about that and finding ways to have that flexibility so that one challenge in one part of the world doesn't destroy their supply chain.
I have another question. I should preface this. Do you own any crypto?
No.
And I guess some investors consider crypto as being, I guess, a medium of exchange that will eventually become a currency that transcends borders. People treat it like an asset class to hedge against systemic risks of markets. People just think it's purely speculative. So I guess that might answer which camp you belong to. But what do you think the future holds for cryptocurrencies?
I think it's, again, one of these things that, it's hard, and this is not always perfect, and Charlie, I know, has some strong opinions about this, but the one analogy I always give is that you can, whether you're a growth manager or a value manager, see things before everyone else sees them is where great success happens. You see it in sports. The great passers, whether it's a quarterback or it's a point guard, they see people open before they're open. That's why they're so good. They throw the puck ahead, or they throw the ball ahead, or whatever it happens to be. So vision is just so important. So if you were going to invest in crypto, it would have been better to do it early on while everyone was getting, and where you had a vision, you saw the potential. Then when it gets to a point now where everybody wants to talk about it, and everyone from the guy that delivers my pizza to when I talk to high school students, everyone wants to talk about crypto. Well, it's hard to get rich once everyone's already discovered the secret sauce, So I would just start with that point. I think whatever you do, value growth, being able to see things before others see them is the secret to being really, truly successful.
The only thing I'd add to that is it'd be a good idea for people to review their history of the government's regulation of gold. The U.S. government made it illegal for individuals to own gold in the 20s and 30s, and they did it because they didn't want a competitor to the dollar. And I just think you have to be careful here, because the U.S. government has no incentive to come up with a global competitor to the US dollar in which people can hide their profits from the IRS. And so there is, in my opinion, big risk of regulation, if not outright bans on crypto ownership. And it does not help that one of the big use cases for crypto and Bitcoin right now are illegal activities and tax avoidance. So I would be very careful about having a significant position in crypto or Bitcoin or other currencies.
Okay, I think let's move on to a question from the audience. So we have a question from Alex Ding. He asks, macroeconomists are uncertain about QT, so quantitative tightening's impact on the economy. How will the market deal with these?
Charlie?
Yeah, that is an uncertainty. It's going to depend on how hard and how fast they go. This was always the danger with those of us who were critical of the Fed, that they were so slow to recognize inflation. The danger was that they would then overreact. So far, I guess they're talking 25 basis point increases and very modest selling of this $9 trillion portfolio that they've accumulated. Now, but there's a risk that they get it wrong and raise rates too fast, and there are global events around the world that combine and we get a recession. I think again, it's hard to predict the economy, but I think John and I both were pretty bullish on the economy. But I will say there is a danger that the Fed could get too aggressive in raising rates and selling bonds and could cause problems. But we're still hopeful that there's so much pent-up demand. Consumers have very strong balance sheets. People want to buy cars. They want to go on vacations. They want to go out for dinner. So we're still hopeful that we can have a safe landing here.
We have another question from David, a bit more lighthearted. But John, rumor has that you often played basketball with President Obama. And has he ever encouraged you to run for political office?
Oh, thanks for that. It's interesting you mentioned that. I guess this week on public television, Newt Minow, who was a sort of famous lawyer in Chicago who used to be in the Kennedy administration, he's an elderly guy, recommended me for mayor on television. So I've been getting calls all week, and people wanted to talk about it. But to answer your question directly, no, the president knows that I love Ariel and love my business, and he knows I don't have the personality for a public office.
Okay, question from Jared. How important is leadership in small cap companies, and what traits do you look for in company leaders before investing?
Yeah, very important. Leadership is really important in smaller companies. The smaller the company, the more important it is. But again, small and mid-sized, we think it's really critical. When we go and see people, I think one of the things we're looking for is somebody who knows how to want to attract great other people. You're running a company with a team. And it's one of the things, we were talking about this last night. There was a celebration for former President Bob Zimmer. And one of his gifts at the university was the ability to consistently get the strongest teammates to help him lead the university. So we're trying to see not only is the leader very, very strong, but he's been able to surround himself with great people. The second thing we're looking for is do they have a clear plan to win? We just think it's so, when you're with a smaller company and you want to be successful, you should have that 3-5 year strategic vision that's crystal clear, that you can communicate to your shareholders and you can communicate to your employees. What are your priorities? And then you can be evaluated on how consistently you execute along those priorities. It's shocking to me how few CEOs actually have a clear plan to win. Let's right now at McDonald's, where I'm on the board, they have 3 Ds. It's delivery, digital, and drive-through. Those are the 3 key things that they're working on. The fact that I know those 3 things and understand them means that our CEO, Chris Kay, has a clear plan to win. So that's something I'm looking for. Third one is you want management teams to understand capital allocation decisions, understands where CEOs get into real trouble is they want to grow too fast, borrow money inappropriately, make acquisitions outside of their circle of competence. You want to see people who are focused on the business, love the business they're in, and are not always searching for something better somewhere else. We've got a company that we're worried about now because the CEO's always got Wunderlist looking outside of his core competency, we think. So that, I think, can't overemphasize how important that is, like understanding capital allocation. And then finally, we love companies that they care about their shareholders and their customers. You can tell. It's not about them. You see the CEOs like, it's all about how much money they're going to make and how they're going to get this title or this award or this honor or this, everything's about them. They're going to do all the talking. You want to find a CEO who's talking about how he's pleasing customers, how he's attracting customers, how he's keeping his teammates in place, and then how he's concerned about shareholder value over the long run. You can feel it when you've got a management team like that.
Great. And I guess a final question for both John and Charlie. What advice would you give for undergraduates who wish to pursue investing as a career?
For me, it's clear. I tell everyone, I'm sure some of you guys are already doing this, exploring internships with your endowment office. I know we have a new CIO at Chicago, Andy Ward, but being in an endowment office is just a great place to learn because the major endowments have money in venture capital, in private equity, in hedge funds, invested in real estate and commodities, invested internationally. The best money managers in the country come fly into Chicago to see the CIO and the staff. And, so you get to meet the David Rubensteins of the world, which you guys have already met him because you guys are UFC students. But, if you're in an endowment office, all the big guns come in to pitch their services and you get a chance to see them and learn from them and, see how they present, what they talk about, figure out what asset class you're most comfortable in. That's my number one thing. Find a way to intern, spend time in the endowment office. That exposure, I think, is invaluable.
Yeah, it's always hard to answer this question because you get so many pieces of advice you give. But one thing I would just say is all the successful investors that I know read all the time. They read books, they read newspapers, and they don't read a lot of social media posts. And I know it's hard, and I read too many social media posts myself, but just they all, see behind me, I have my library of books, and I have a Kindle, and I have all the books that I have my audio books that I'm listening to. Read, and you'll get smarter. You will impress your future bosses and potential clients. You'll become more articulate from reading. And it just gives you an advantage today that frankly social media can't give you.
Great.
The only thing I would add, last word, is that I completely agree with Charlie. But the other thing that, I get to meet Charlie in high school, as I mentioned, I've met great investors in college, and early in my career, I would meet great investors who were people like Charlie, people who were reading and accomplished and smart and thoughtful about the markets. So when you're early in your career, build relationships with other people who love the markets, and they can be your business partners 20 years later, 10 years later, 5 years later, someone you can bounce ideas off of, learn from. It's so much easier to build lifelong relationships when you're young than trying to call up somebody who's already a big success and they're already 50 years old. It's hard to replicate that. So read a lot, build great relationships with smart people who love the markets. And as I mentioned earlier, I think working your endowment office, I think, is a great idea.
Great. Thank you so much for that tremendous and very tangible advice. Yeah, I think that's all the time we have to review. Thank you so much, John and Charlie, for joining us and taking the time to speak with us, students. We really appreciate it. And I think that's it. Thank you so much.
Yeah. One last thing. Sorry. If any of you guys are interested in Ariel, interested in value investing, because I know you guys are interested in venture capital, but if any of you are interested in value investing, if we know by December, we can usually fit people in as summer interns. So if there's anybody, whether it's, while you're still in college or whether you're in business school, during that 1 year between first and second year, we're always looking for talented people who want to learn more about value investing.
Awesome. Thank you so much for that. Thank you so much, guys. Take care.
Thanks.